Market structure shift is not a priority. And what I mean by that is you don't necessarily need to see a market structure shift before taking a trade. It can act as an additional confluence, but it doesn't have to be the main focus. Now, let's say price is reacting at a higher time frame point of interest, and you start seeing this exact structure form. A lot of traders at this point would want to take the trade from the breaker block simply because they see a market structure shift. They expect the market to push to the upside. But what usually happens? Price ends up stopping them out. So why did that happen? It happened because there was no displacement in the bullish leg that broke structure. Now, don't get me wrong, this is still a solid approach. However, the most important part of the setup isn't actually the market structure shift itself. What really matters is the displacement. Displacement is what truly shows us how the market is shifting structure, and that's the key thing to focus on. If you get a market structure shift without displacement, the setup is most likely invalid. But if you get strong displacement, even if it doesn't clearly break structure, that setup is still valid. Let me explain this clearly. Imagine price has returned to a higher time frame point of interest. After a previous high gets swept, or after an SMT forms within that higher time frame point of interest, the next few candles that follow must be impulsive. That impulsiveness clearly shows us that price wants to move away from that point of interest, which is exactly what we want to see, not necessarily a market structure shift. The most important thing here is the displacement. Those impulsive moves leave behind fair value gaps, and that allows us to enter the trade earlier with a better risk to reward ratio. And if after that displacement, we also get a market structure shift, then that simply becomes an added confluence, not a requirement. Now let me show you some examples of trades I've taken in the past that follow this exact scenario so you can understand it a lot better. Now, this is the first example I'm going to show you, and it's a trade I took on the 22nd of January, 2025. Here's the proof. Let's break this trade down so you can clearly see exactly what I was talking about. First of all, we have a 4-hour fair value gap sitting right here. When I dropped down to the 15-minute chart, I noticed an SMT divergence. You can clearly see it here. Euro USD created a higher low, while GBP USD created a lower low. Now, after seeing this SMT divergence, most market structure shift traders would have waited for this swing high to be taken out. But I didn't wait for that. What I was expecting instead was this. Immediately after the SMT, the next few candles should be impulsive candles, and they should leave behind a fair value gap. If that happens, we can confidently take the trade. And that's exactly what happened. As you can see, the next two candles that formed were impulsive and left behind a fair value gap. So I took my entry from that fair value gap, placed my stop loss just below the SMT low, and set my take profit at a 1 to 2 risk to reward ratio. And as you can see, price tapped into our entry and pushed straight to take profit without even needing to form a market structure shift. Now, this is our second example, and it happened on April 23rd, 2025. Let me walk you through this trade so you can clearly see what happened. First of all, price tapped into a 4-hour fair value gap. After that, we dropped down to the 1-hour time frame. And the first thing I noticed was this. Price tapped into the 4-hour fair value gap and swept liquidity. Now, after a liquidity sweep, what did I tell you? You don't necessarily need to wait for a market structure shift. All you need to do is wait for the next few candles, the next 2 to 3 candles, to move impulsively and leave behind a fair value gap. Once that happens, you can take your trade. And that's exactly what happened here. Price moved down impulsively and left us a fair value gap. So I took my entry from that fair value gap, placed my stop loss just above the swing high, and set my take profit at a 1-to-2 risk to reward ratio. And this is exactly how the trade played out. Now, if you were waiting for a market structure shift, this trade would have already played out without you being able to take advantage of it. Now, this is the last example we'll be looking at in this video, and it happened on March 27th, 2025. So let's head straight into it. First of all, we can see that price tapped into this 1-hour fair value gap. Now, when we drop down to the 15-minute chart, there's a very clear SMT divergence right here. We can see that Euro USD created a higher low, while GBP USD created a lower low. And after that SMT, just like I explained earlier, the next 2 to 3 candles must show impulsiveness and leave behind a fair value gap before we take a trade, regardless of whether structure is broken or not. And right here, we can see that the next 2 candles after the SMT did exactly that. They created a fair value gap. In this case, price also broke structure, which simply becomes an added confluence, not a priority. So we set our entry from that fair value gap, place our stop loss just below the SMT low, and target a 1-to-2 risk to reward ratio. And as you can see, take profit got hit. This is how I trade every single month, and it has been working consistently well. Now, this doesn't mean you can't wait for market structure shifts or make them your priority. It really comes down to your personal trading style. Both approaches can work. The main thing you should always focus on is displacement. Once you have displacement, whether it breaks structure or not doesn't really matter. That's all for today's video. If you learned anything from it, give it a thumbs up and subscribe. I'll see you in the next one.